Joining us now, Sonali Basak from iCapital's. Sonali, great to have you with us.
Guys.
And you say, yes, you think the markets are going to go higher, but it is time to hedge.
Yeah, we definitely think it's time to manage downside protection, given what we've seen in the markets. We do think we can go higher from here. So we're looking at now about 7,500 to 7,800 based on fair value. We know earnings are growing. We don't think you can get that much more multiple expansion. But we also think that, listen, the second half of the year is really uncertain. There are a lot of sources of liquidity that we had really helping drive us for the first half that we think could start to have fading ramifications here for the second half. So we don't think that the path forward is linear, and we think that there are a lot of investors vulnerable to drawdowns in different parts of the market.
And I guess hedging can take many forms. Obviously, you could just do outside buy, downside protection, but some have made the case, look, if you bought exposure to energy, it actually acts as a counterweight to most of what's been working now.
Right, especially when you see the cross-asset moves not working for you. When we talk to our clients, they're pretty upset about the dynamic in the 60-40, right? The fact that bonds have not really been working, the fact that commodities have been challenged and not getting back a lift. For our clients, they look at structured investments as well. So buying into areas like software, where we've already seen a meaningful retracement this year, but still a lot of uncertainty. So single names there. But even in the broader indices, you do see meaningful hedging.
Sure.
The backdrop to this broader market move higher, though, is rates will be higher, too. I mean, you've moved up your forecast for the range on the 10-year as well. So do you also see oil price, energy prices remaining higher for longer?
Energy prices and just an overall strong backdrop. You think about what we're seeing, Red Book retail sales, still the highest level since 2022. So really strong consumer impulse here. You saw it in the GDP data for the first quarter. Despite what we're seeing in the broader market here, if you are worried about oil prices hitting your wallet, you're not seeing that flowing through to spending today, but those tax refund benefits are starting to wane also. And so, yes, we don't think the impulse will be as strong. It doesn't need to necessarily fall off a cliff. But with that said, you know, if you don't see the economy falling off, then certainly in addition to the oil prices contributing to further inflation, you also still have that against the backdrop of a fairly strong economy.
You cited some sources of liquidity that maybe are waning, and I'm just wondering what that looks like. There's obviously voracious demand for capital for the CapEx story, the AI CapEx story. You know, private credit is lining up. We're raising new rounds of equity in terms of OpenAI, and the government's still borrowing what it's borrowing. And I'm just wondering if there's other things you're watching at this point, because we're going to have some big IPOs, and it's going to offset a lot of what we've come to know as heavy buyback activity.
Yeah, I'm sure you guys know. Everybody is talking on the street about what these IPOs mean for the market. Are investors going to really have to meaningfully rebalance their exposure into some of the other high flyers into these big names? Will they perform well? At what point do the AI CapEx vigilantes show up? That's the question we're starting to ask. Remember, if you have money flowing into public bond markets and then flowing in from private credit markets, those spreads compress. And therefore, you might have investors starting to say, am I getting the return that I want with so much competition for capital, let alone the companies themselves not returning that? Just really quickly, Melissa, on our updating the range for the bond market here, 4 to 4.8% is what we're looking at the 10-year. 4 to 4.5, fine. The market can absorb it. 4.8 looks a little messier, doesn't it?
I would think.
Yeah, and that's the danger zone. If we start to get past 4.5 meaningfully, we think investors are going to start to see more hiccups in broader markets. But from 4 to 4.5, we can get away with it. You're just going to have a lot of borrowers here facing dispersion, because some of them will be fine in weathering those interest rates. Some of them will not make it through as easily, and the equity will start.
That seems like a pretty narrow margin of danger. I mean, you know, people talk about, the 1999 move when the NASDAQ tripled or whatever in a year.
Yeah.
I mean, 10 years at 6. I know it's a different world.
Yeah, it's a different world.
But it had come from a different place. But it's interesting that we're now talking about below 5% could be an issue.
It's interesting that you say margin of error. That's another way of thinking about it. We were thinking about this as, an equity market that is just looking at bigger fat tails at this point in time. And that's where the vulnerability lies.
Tails on both sides.
Tails on both sides, right? I mean, there's upside risk to this market, too. You could have inflation. We've been living above 2% now for years. So the question is, what breaks on the back of that?
Sonali, thank you.
Thanks.
Good to see you.